Welcome to the Deep Dive, where we take your sources, articles, and research and distill them into the most important nuggets of knowledge. Today, we're diving into a fascinating paradox. How can a company be a technological titan, really poised to power the future of electric vehicles, clean energy, yet at the same time find itself in, well, financial ruin? We're going to unravel the story of Wolfspeed, Inc. and reveal how value can seemingly evaporate for some, even as the core business itself retains immense potential. So, let's jump right in. We're taking a deep dive into Wolfspeed, ticker symbol WOLF. We've pored over the latest analysis, and it's all anchored to July 25, 2025. Now that date is critical, because that's when Wolfspeed made the really difficult decision to file for Chapter 11 bankruptcy protection. So our mission today is to understand how a company at the absolute forefront of a booming industry ended up here, what its future might look like, and most importantly, what this all means for you.
Yeah, it's a really interesting one. What's truly fascinating here is that Wolfspeed isn't just any company. It's an undisputed pioneer in silicon carbide technology. This analysis will help us understand not just what happened on the surface, but really why it happened. It provides essential context for this incredibly complex situation.
Okay, let's start with Chapter 1, Business Understanding. A fallen leader in a booming industry. Can you walk us through Wolfspeed's core business, and why exactly was it considered such a leader?
Absolutely. So Wolfspeed is, or was, a vertically integrated global leader in wide-bandgap semiconductors, specifically silicon carbide, that's SEC, and gallium nitride, GaN. Now, think of vertical integration as controlling the entire supply chain, right? From growing the raw crystal materials all the way to fabricating the finished chips. Their main revenue streams were selling these six-setting materials, basically wafers, to other manufacturers and also producing their own finished power and RF devices.
Okay, that vertical integration, it sounds like a huge competitive advantage on the surface,
Yeah.
having control over everything, but I'm guessing there's a flip side.
There absolutely is. It's a classic double-edged sword. On one hand, yes, it provided a significant technological moat. It created this powerful competitive barrier because very few others could really replicate their end-to-end expertise. But the other edge of that sword, it demanded immense capital expenditures. We're talking billions of dollars annually. It reached somewhere between $1.7 billion and $2.3 billion in recent years just to build out their factories. And all that cash burn led to a deeply negative free cash flow. We're talking nearly negative $3.0 billion in fiscal year 2024 alone. As our source material puts it quite aptly, I think, the moat became an anchor, just incredibly expensive to maintain.
Wow. So what exactly were these specialized sync command devices used for? Can you give us some real-world examples, something that illustrates their impact?
Sure. Think about the backbone of modern tech, really. SiC power devices, they're critical for electric vehicle powertrain inverters. These manage the power flow, crucial for efficiency. Also, fast charging infrastructure, renewable energy systems like solar and wind inverters, even data centers. And then the GaN RF devices, they're essential for high-frequency applications. Think 5G telecommunications, advanced radar and aerospace, defense systems, that kind of thing.
That really brings it to life.
Yeah.
And the core value proposition for these materials, beyond just their uses, why are they better?
Well, the fundamental value proposition is superior performance compared to traditional silicon technology. It's pretty straightforward. SiC and GaN have wider band gaps. Now, without getting too technical, this basically allows them to operate at much higher voltages, higher temperatures, and switch power much faster. For you, the end user, this translates into real, tangible benefits. Things like longer EV range, faster charging times, higher energy conversion efficiency in your solar or wind systems, and lower power consumption for 5G networks and data centers. It's not just a small improvement, it's a genuine step change in performance.
Got it. Now let's look at the broader industry. What were the big trends Wolfspeed was operating within?
Wolfspeed was positioned right at the heart of several really powerful global megatrends. You've got the widespread electrification of transportation, the massive shift towards renewable energy sources, and of course the build-out of next-generation communications infrastructure, particularly 5G.
And these markets are projected to grow quite significantly, correct? I mean, the demand seems undeniable.
Oh, exponentially. The silicon carbide market, it's projected for a compound annual growth rate, a CAGR, somewhere between, say, 8.7% up to a staggering 34.5%. That could mean a market size of $9 billion to over $12 billion by the early 2030s. And the gallium nitride market shows similar promise, CAGR between 17% and 27%, hitting maybe $9 billion to $12.5 billion by 2030. These are just immense growth trajectories.
So here's that paradox again.
We have this almost guaranteed long-term demand for Wolfspeed's products, yet the company still failed financially. What does that tell us about the journey for these kinds of deep tech, capital-intensive companies?
It really highlights that while the destination for these industries might seem clear, the path itself is incredibly perilous. It's characterized by massive front-loaded capital investment, years before significant returns materialize. Plus, you had that temporary EV market slowdown in 2024 and early 2025. That really impacted suppliers like Wolfspeed, compounding their cash flow issues just when they desperately needed that production ramp up.
Yeah, timing is everything.
Yeah.
And I imagine the competitive landscape is just brutal. Who are Wolfspeed's main rivals, and how did their efficiency maybe magnify Wolfspeed's problems?
Oh, the competition is intense, fierce, really. In SiC-high power devices, they're up against giants like Infineon Technologies, ST Microelectronics on Semi. In GaN RF, you've got major players like Qorvo. These aren't small companies. They are some of the most efficient and powerful manufacturers on the planet, operating at enormous scale. Wolfspeed's financial missteps, particularly the cash burn, meant they just couldn't compete effectively on cost or production efficiency. It became impossible to match the razor-thin margins and the massive scale that these, frankly, formidable rivals could achieve.
And what about regulatory factors? Any tailwinds or headwinds there?
Well, there was some tailwind from the U.S. CHPS and Science Act, right? That offered funding for domestic manufacturing, which should have helped. However, there are also significant geopolitical headwinds. Think about China's dominance over raw gallium supplies. That's a key input. And then there's the potential for U.S. trade tariffs on components, which can disrupt supply chains and definitely increase costs. It's a complex picture.
Despite all these challenges, are there still significant barriers to entry in this market that protect existing players, even struggling ones like Wolfspeed?
Absolutely. The barriers remain exceptionally high. First, you need multi-billion-dollar factories, these fabs. Then there's the deep technical expertise. Our source describes it as a black art, meaning it takes decades of specialized research, manufacturing know-how, patents, things new players simply can't replicate overnight. Plus, you have these years-long customer qualification cycles for new components in critical applications like automotive. These factors definitely protect incumbents.
So what competitive advantages does Wolfspeed still retain, even now, in bankruptcy?
Well, they still have a strong brand. Remember, they were formerly known as Cree, a real pioneer in LED lighting, and then SiC. There's also the potential for significant cost advantages from their new state-of-the-art Mohawk Valley 200mm fab, if it can be successfully ramped up to full production and high yields. That's a big if. And crucially, they possess deep intellectual property in Saxi crystal growth and device fabrication. That remains a formidable asset, no question.
Okay, that gives us a good picture of the business itself. Now, the logical next step is to examine the leadership that steered the ship, or perhaps sailed it into these troubled waters. So let's move on to Chapter 2, Management Evaluation, a new crew for a sinking ship. Tell us about the changes in leadership. It sounds pretty dramatic.
Oh, it's a dramatic overhaul, definitely. The old guard, that's former CEO Greg Lowe and CFO Neil Reynolds, they were undeniably visionary. They correctly identified the immense market opportunity in CC and, they bet big, investing billions to seize it. However, their strategy, this debt-fueled expansion, combined with operational execution challenges and that EV market slowdown, it just led to unsustainable cash burn. Ultimately, that forced their departures.
So the board brought in a new team. Who are these new leaders and what's their background? Sounds like they needed specialists.
Exactly. The new guard includes CEO Robert Furl, who came aboard in May 2025. He's a seasoned semiconductor veteran, 30 years of operational experience, notably from Infineon, one of their key competitors. And what's particularly insightful, actually, is that he conducted due diligence on Wolfspeed during a proposed acquisition way back in 2016. So he had intimate prior familiarity with the company's inner workings. Then there's CFO Gregor van Isem, appointed in September 2025. His background is explicitly noted as a transformation and strategic financing expert. Tells you everything you need to know, right?
Yeah, that title screams restructuring. So this sounds less like a routine management change, much more like a deliberate crisis response team being assembled. Was that how the market saw it too?
Precisely. It's quite clear this is a deliberate formation of a crisis management and restructuring team. No doubt about it. And the market definitely received that signal loud and clear. There was actually a powerful, although brief, stock price surge right after Van Isem's hiring was announced. It indicated that investors, or maybe speculators, saw this as a serious step toward potentially navigating the bankruptcy and achieving a viable turnaround.
In a situation like this, how important is transparency in their communication with creditors, customers, everyone involved?
Oh, it's absolutely crucial, paramount, really. And amidst this crisis, their communication seems to have been direct and procedural. They've been transparent about the Chapter 11 filing itself and the terms of the restructuring support agreement, the RSA. This kind of clear communication about the debt reduction plan, operational continuity, it's vital for maintaining any shred of credibility with customers, suppliers, and especially the creditors during such a complex process.
Right. Now let's talk about capital allocation. How did their approach to managing money contribute directly to their downfall, and what's the plan looking forward?
Well, historically, their capital allocation strategy was relentless. It was massive, debt-fueled investment in organic fab expansion, building these huge factories. And as we discussed, this was the direct cause of their collapse. The spending just vastly outpaced revenues and operational cash flow. Interestingly, there was no significant M&A activity. The focus was entirely internal, on building. Moving forward, the strategy has done a complete 180-degree turn. It has to, right? Now it's all about survival and optimization. The primary goals are clear. Complete the financial restructuring under Chapter 11, significantly lower their operational break-even point, and somehow eventually achieve profitability. This means trying to finally ramp up utilization at that new Mohawk Valley fab and strategically closing the older, less efficient Durham 150-millimeter fab, cutting costs.
And for the people holding the stock, the current shareholders, what does this mean in terms of returns, dividends, buybacks?
Yeah, for current shareholders, the picture is bleak. There have been no capital returns for a long time, no dividends, no recent share buybacks. In fact, existing shareholders have already faced significant dilution from past capital raises. Now, in bankruptcy, there's effectively zero prospect of any returns for current common shareholders. Their equity value is, for all practical purposes, wiped out.
The numbers really confirm the story here, don't they?
Yeah.
Okay, let's dig into Chapter 3. Financial analysis, deconstructing the bankruptcy. What do the final figures look like just before they filed?
Right. So as of that anchor date, July 25, 2025, Wolfspeed stock closed at a mere $1.64 per share. That put its market capitalization at approximately $255 million, which, reflects a near total collapse from its previous highs, which were in the billions.
And how about their revenue trends leading up to this? Were they still growing or had that stalled?
It's a mixed picture, but ultimately negative. While they did have a respectable 5-year compound annual growth rate of about 8.4% up to fiscal year 2024, their more recent trailing 12-month revenue actually declined by nearly 6% year over year, down to about $761 million. So that indicates a significant and troubling reversal of momentum right when they needed growth the most.
And profitability. Were they actually making any money on what they sold?
No, not even close. Their profit margins were devastatingly negative. Just look at the most recent quarter before filing. Gross margin was negative 12%, operating margin negative 105%, net profit margin negative 154%. These numbers mean the company was losing substantial money on every single sale and every operational activity, bleeding cash at every level.
You've mentioned free cash flow before as being critical. Just how bad did that get?
Free cash flow, FCF, generation. It really is the single most critical financial indicator here. And it was catastrophic. Wolfspeed experienced what can only be described as an accelerating hemorrhage of cash, a death spiral, really. It went from negative $256 million in fiscal 2020 to nearly negative $3.0 billion with a B in fiscal 2024. This created this enormous unfillable funding gap that they repeatedly tried to plug by taking on more and more debt, which of course just led to an entirely unsustainable capital structure.
Which brings us to the debt levels. How bad was that?
Astronomical. Their debt-to-equity ratio was over 30.66, which translates to over 3,000%. That signifies an equity base that has been completely eroded, just overwhelmed by debt. It's a classic sign of impending insolvency. The actual number was around $6.5 billion in long-term debt on the books.
Okay, but here's something slightly counterintuitive I saw. Their current ratio actually looks strong, over 4.0 on paper. How can that be possible if they were burning so much cash?
Yeah, that's a great point, and it's dangerously misleading, as the analysis highlights. While the ratio technically showed a large cash balance relative to short-term liabilities, that cash was almost entirely sourced from recent debt issuances, not from profitable operations. So it completely masked the underlying problem. It failed to capture the unsustainable trajectory of a business burning through billions of borrowed dollars every year. It wasn't real liquidity.
Right, makes sense. So given all this, Traditional valuation metrics like PE are probably completely useless here, right?
Exactly. Totally distorted. Their price-to-earnings ratio is listed as not meaningful, or NM, simply because they had consistent negative earnings for years. Their price-to-sales ratio was exceptionally low, around 0.33. That already signaled the market's strong expectation of equity cancellation happening in bankruptcy. The market saw this coming.
Okay, so if the old metrics don't work, how do we even begin to think about valuing a company in this specific situation? Is there any value left?
Well, not for the current stock. But for valuing the new entity that might emerge after restructuring, a discounted cash flow, or DCF, analysis is the appropriate method. Now, this is purely a hypothetical exercise at this point, but based on projections assuming a clean balance sheet post-bankruptcy and a successful operational ramp-up, the estimated fair value range for this new equity could potentially be somewhere between $20 and $35 per share. But, and this is absolutely critical to hammer home, this valuation has no bearing whatsoever on the currently traded Wolf stock. Zero. It's a valuation for a completely different future ownership structure, the one owned by the creditors.
Understood. Crystal clear.
Mm-hmm.
Okay, so with all those grim numbers in mind, how is the market actually reacting to Wolfspeed's situation now? Let's dive into Chapter 4, Market Sentiment, betting on a turnaround or a wipeout.
Yeah, the market's view on Wolfspeed is incredibly fractured, as you might expect.
Yeah.
You have extreme bearishness for the existing Wolf stock, the one trading now. But that's directly contrasted with a kind of highly speculative, maybe even lottery ticket type hope for the future restructured company, the new equity that doesn't exist yet.
And what are the Wall Street analysts actually saying? Are they recommending buy, sell, hold?
Their sentiment really reflects this profound uncertainty. Generally, they've settled on a non-committal hold consensus rating, which in this context often means we have no idea, stay away. And look at their price targets. The range is exceptionally wide, from $1.50 on the low end, basically predicting zero, up to $13.34. Now, that high end likely represents wishful thinking about a successfully restructured company's potential value sometime in the future, while the low end points to the much more probable near zero value of the existing shares.
And the overall news flow has been consistently negative.
Overwhelmingly negative, yes. Dominated by reports of financial distress, the bankruptcy filing itself. However, there was that brief positive blip we mentioned earlier when the new restructuring-focused CFO was announced. The market momentarily interpreted that as a serious step towards maybe, just maybe, a viable turnaround down the road. But the negativity quickly returned.
An incredibly strong market indicator in situations like this is short interest, right? The percentage of shares betting against the stock. What does that tell us here?
Yeah, it's a huge signal. Short interest is exceptionally high. Over 34% of the public float, that's about 53 million shares, are being shorted. This is an extremely bearish signal. It indicates a very large contingent of informed institutional investors are betting heavily that the current common stock will fall further, likely towards near zero, based explicitly on the terms laid out in that restructuring support agreement we keep mentioning. They've read the writing on the wall.
How does the current share price, that $1.64, relate to its moving averages? Does that tell us anything?
Well, interestingly, the share price at that moment was actually trading slightly above its 50-day moving average. That suggests perhaps a short-term bounce, likely driven by speculative day trading or maybe short covering. Noise, basically. However, crucially, it's drastically below its 200-day moving average, which sits much higher. This confirms the severe, sustained downtrend is very much intact. The long-term picture is bleak.
Okay, now here's where it gets really interesting, I think. Who will actually own Wolfspeed after it emerges from Chapter 11? This is Chapter 5. Ownership structure, a changing of the guard. What happened with the big institutional owners, the Vanguards and BlackRocks?
Yeah, this is key. We've seen a clear institutional flight, a mass exodus, really. Major index funds and institutional holders like Vanguard and BlackRock drastically cut their stakes leading up to the filing. We're talking reductions of 45%, 55%, huge sell-offs, and this is simply a rational response. They're trying to avoid a near total loss as the bankruptcy terms became clearer. They got out while they could get anything.
And what about insiders, company executives, directors? Were they buying or selling?
So, insider trading activity over the past year before the immediate crisis actually showed a net buying trend, which can often be seen as a positive signal. However, there's a very telling absence of any recent open market purchases by insiders as the bankruptcy loomed. In fact, the last notable transaction mentioned was a sale by the former CFO just before his departure. Insiders often have the clearest view of what's coming, and they weren't buying shares on the way down.
Okay, so The million-dollar question, or maybe the $0 question for current holders: what happens to the existing common stockholders under the bankruptcy plan?
Yeah, this is the crux of it for anyone holding Wolf stock now. Crucially, the restructuring support agreement, the RSA, dictates a complete changing of the guard. It's not subtle. Existing common stockholders are expected to receive only a tiny sliver, somewhere between 3.0% and 5.0% of the new common equity in the reorganized company. This means a devastating 95% to 97% dilution. It's an effective wipeout for current shareholders. Their ownership value is largely being transferred to the creditors.
And who are these new owners going to be then? Who gets the other 95+%?
The vast majority of the new equity, the ownership of the reorganized company, will go to former creditors who are swapping their debt for ownership. Specifically, about 56.3% of the new equity is slated to be held by the convertible notes holders. And critically, a major strategic customer, Renesas Electronics, is set to receive a substantial 38.7% of the new equity, plus warrants for potentially more later.
Wow. That's a profound shift in ownership. What are the implications of this new, highly concentrated ownership structure going forward?
It means the new ownership will be highly concentrated, absolutely. You'll have financial players, former note holders, primarily focused on maximizing their recovery and the future financial value of their new stake. And then you have Renesas, focused much more on strategic supply assurance and ensuring operational stability from a key supplier they now partly own. Their combined incentives, which aren't necessarily aligned, will now dictate the company's future strategy and direction. It's a stark change from the previous broad base of public shareholders.
Okay, so what does this all mean for the road ahead? What are the biggest hurdles and opportunities for Wolfspeed as it tries to navigate this new chapter? Let's explore Chapter 6, Risk Assessment, a minefield of uncertainty. Can you give us a quick SWOT analysis? Strengths, weaknesses, opportunities, threats?
Sure. Let's break it down. For strengths, Wolfspeed still possesses that core technology leadership in SIGIT. They have valuable vertical integration, even with its costs. They have the state-of-the-art 200mm Mohawk Valley fab, which is a huge potential asset if ramped correctly. And they retain strong, albeit likely strained, customer relationships.
Okay, but the weaknesses seem pretty overwhelming right now.
Oh, indeed. Glaring weaknesses. Financial ruin, obviously, the bankruptcy itself. Significant proven operational execution challenges, particularly in ramping up those fabs efficiently to get yields up and costs down. There's undoubtedly a damaged reputation among suppliers, customers, and the market. And they have a heavy market concentration in the currently volatile EV sector.
Right. On the flip side, looking forward, what are the potential opportunities for this new restructured entity?
The opportunities for the new entity are potentially significant, assuming they navigate the bankruptcy successfully. First and foremost, a clean balance sheet, hypothetically shedding around $4.6 billion in debt. That's huge. They'll be better positioned financially to serve these immense secular growth markets, EVs, renewables, 5G, AI data centers. There's a plan for streamlined operations, closing that older, less efficient 150mm fab. And there remains the potential for eventual cost leadership if, and it's a big if, that 200mm fab successfully ramps to full production with high yields.
Okay, and finally, what about the threats that still loom large, even post-bankruptcy?
The threats are very real. Intense competition from much larger, financially stronger, more efficient rivals isn't going away. There's significant execution risk. There's absolutely no guarantee that the new management team, despite their expertise, can solve the deep-seated operational issues that plagued the old company. A potential prolonged EV market slowdown would still hurt them badly. And critically, the biggest threat, at least for current investors, is the near certainty that their existing shares will be rendered effectively worthless by the dilution.
Makes sense.
Yep.
And how do broader macroeconomic and geopolitical factors play into this risk assessment?
They definitely add layers of complexity. On the macroeconomic front, persistent inflation means potentially higher costs for materials, energy, labor squeezing already non-existent margins. Higher interest rates increase future borrowing costs should they need more capital, and they raise the hurdle rate for justifying new investments, making future growth potentially more challenging. For geopolitical factors, Wolfspeed faces this kind of dual exposure. For example, proposed U.S. tariffs on something like copper imports would increase their input costs. Conversely, Wolfspeed itself has actively advocated for significant additional tariffs on Chinese-made sign-on wafers and devices. That could actually protect its domestic operations if enacted. So they're highly sensitive to trade policy shifts, which adds another layer of uncertainty.
Okay. Wow. We've journeyed through Wolfspeed's core business its dramatic financial downfall, the complete changing of its guard, and the considerable risks still ahead. Now let's try to synthesize all of this. We're moving to Chapter 7, Conclusion.
Yeah.
What's the core takeaway here?
Yeah, the core paradox here is really profound, isn't it? Wolfspeed stands at this critical inflection point. It's defined by this stark contrast between its undeniable technological prowess and its equally undeniable financial failure. The investment thesis, if you can call it that, is truly paradoxical. The underlying business may possibly be on the verge of a new beginning under new ownership, but the current stock, Wolf, is unequivocally at the end of its life.
So for the new entity that might emerge from bankruptcy, what's the bull case? It really sounds like that classic good company, bad balance sheet story, potentially.
Exactly. That's the optimistic view for the future entity. The bull case is cleansed financials, potentially reducing debt by that huge $4.6 billion figure. It retains world-class assets, the Core 6 technology, the valuable IP, that advanced 200mm fab, hopefully key customer relationships. There's new, focused leadership in place specifically chosen for restructuring. And the underlying business is still riding those powerful secular tailwinds in critical future industries.
Okay, but then there's the bear case. Let's be clear about this, both for the current stock and for the prospects of the new company.
Right. Let's separate them. For the current Wolf stock, the bear case is frankly overwhelming and straightforward. The existing equity is, for all practical purposes, worthless. The restructuring support agreement explicitly states that 95% to 97% dilution, it's written down. That massive 34% short interest we talked about, that represents a large informed market consensus betting that the stock's value is heading towards zero, maybe pennies at best. Any trading happening now in the current Wolf shares is purely speculative gambling on short-term volatility, disconnected from fundamental value. Now, for the new company, the bear case is different but still significant. Emerging from bankruptcy is not a magic wand. It doesn't guarantee success. Those core operational problems, efficiently running the fabs, getting high yields, achieving consistent profits, they still need to be solved, and now against fiercer competition than ever. A prolonged EV market slowdown or continued margin erosion from competitors also remains a very significant risk to the new entity's success.
Right. And just to quickly summarize the valuation point again, our DCF analysis for the potential new equity estimates an intrinsic value somewhere in the $20 to $35 per share range.
Yes, but we absolutely must emphatically reiterate this one last time, that valuation applies only to the new shares of the reorganized company, the ones creditors will receive. It has absolutely no bearing whatsoever on the value or lack thereof of the currently trading Wolf common stock. They're completely different securities.
Okay. So, bottom line, what does this all mean for you, the listener? The current share price of Wolfspeed Inc. at $1.64 precisely reflects the market's severe and frankly justified assessment of the impending and near total dilution that existing shareholders face.
Exactly. While the underlying technological assets and the market position of the business that will eventually emerge from bankruptcy may indeed hold significant future value, that potential value is simply not accessible through the purchase of the current Wolf common stock. The value transfer mechanism here, through bankruptcy, bypasses current shareholders almost entirely. You know, this whole situation raises a really important, broader question, I think. In a world of complex financial instruments, Chapter 11 proceedings, deep technology, how much do we truly understand the mechanics of value transfer, especially when a company goes through such a fundamental restructuring? What assets really matter in the end, and who truly stands to gain when the dust settles? It's often not who you might initially think.
That's a powerful thought to mull over indeed. A reminder of the risks inherent in investing, especially in highly leveraged, capital-intensive sectors.
And just our standard reminder. This analysis was generated by an AI system for educational purposes only. It should definitely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Absolutely. And if you found this deep dive valuable, please do like this video and subscribe to the Stock Analytics AI YouTube channel. Members paying €4.99 a month get priority deep dives on tickers you request. And over the next few months, we're planning on covering all of the S&P 500 stocks, and members get exclusive priority access to those. If you just want a one-off deep dive on a specific company, you can also drop us a super thanks right here on YouTube. Thanks for joining us on the deep dive.